While you're reading this, algorithms are moving billions of dollars on Wall Street without hesitation, without emotion, without ever sleeping. This is not science fiction, not a conspiracy theory, not an overhyped headline. It is the present, and it arrived long before most people realized that something had changed. For decades, Wall Street was ruled by men in suits, smoke-filled rooms and phones ringing off the hook. Decisions worth fortunes were made based on gut feeling, experience, and, more often than not, pure luck dressed up as strategy. But somewhere between the 1980s and the 2000s, something began shifting quietly deep inside the financial system. Computers kept getting faster, data kept getting cheaper, and mathematicians started being valued far more than brokers. And then artificial intelligence entered the scene, not as a future promise, but as a real tool already operating, already generating returns. Today, it is estimated that more than 70% of all trades executed in American markets are carried out by algorithms. 7 out of every 10 transactions do not have a single human finger touching the buy or sell button. That is not a technical footnote. It is a complete revolution in the way money moves across the planet. And to understand what is happening, you need to know the names that built this new world. BlackRock, the largest asset manager on the planet with over $10 trillion under management, runs a system called Aladdin. That system simultaneously processes risk across tens of thousands of portfolios, evaluating variables no human analyst could ever keep up with. Aladdin does not sleep, does not take vacations, does not let ego interfere with analyses and in financial markets. That is an absurd competitive advantage. But if BlackRock represents the institutional power of AI, Renaissance Technologies represents something even more staggering. It was founded by Jim Simons, a mathematician who spent time breaking codes for American intelligence during the Cold War. Simons did not come from Wall Street. He came from academia, and that was exactly what allowed him to see the market in a completely different way. His most famous fund, the Medallion Fund, delivered average annual returns of 66% before fees for more than 3 consecutive decades. To put that in perspective, the greatest human investor in history, Warren Buffett, has averaged around 20% per year over the long run. Renaissance did not hire economists or traditional financial analysts. It hired physicists, mathematicians, linguists, and cryptography specialists. They built models that found patterns invisible to the naked eye, buried across decades of market data. And those patterns, however subtle, were repeatable enough to generate consistent profits at a monumental scale. Then came the Sigma and Citadel, 2 giants that took artificial intelligence to an even more industrial level. The Sigma was founded by David Siegel and John Overdeck, both with backgrounds in computer science and applied mathematics. They treat investing as an engineering problem, collecting every imaginable type of data to feed their models. Weather data, satellite data, aerial images of shopping mall parking lots, credit card spending patterns. You read that, right? Satellite images of parking lots to predict whether retail sales will rise or fall before the official reports come out. That is the level of sophistication these machines operate at. And the average investor has no idea any of this exists. Citadel, founded by Ken Griffin, combines high-frequency trading with quantitative, long-term strategies in a way that very few firms can replicate. High-frequency trading means operating in milliseconds, sometimes executing thousands of orders per second with razor-thin margins that add up to billions. It is as if the machine is playing chess at a speed the human eye cannot even follow. And while these firms dominate the top, the technology has been spreading throughout the rest of the financial sector. Today, smaller hedge funds, traditional banks, and even investment platforms aimed at everyday consumers use some level of AI in their operations. JP Morgan developed a system called LOXM to execute stock orders more efficiently than any human trader ever could. Goldman Sachs, which in the early 2000s had 600 traders on its New York trading floor, now has 2 human traders, and the rest of the work has been taken over by automated systems and software engineers. That number alone should stop you for a moment, because it tells a story that goes far beyond finance. But let's get back to the technology itself, because it is important to understand how these systems actually work. The foundation of everything is machine learning, a branch of artificial intelligence where a system learns from historical data to make predictions about the future. You feed the model decades of price quotes, trading volumes, economic news, quarterly earnings reports, and macroeconomic data. The model finds correlations, weights, and patterns that repeated themselves in the past and carry a statistical probability of repeating in the future. But the newest generation of systems goes beyond classical machine learning. using deep neural networks that loosely mimic how the human brain functions. These networks can process natural language, which means they read news articles, financial reports, and social media posts in real time. If the chair of the Federal Reserve gives a speech at 2 p.m. and uses a specific word that has historically preceded an interest rate hike, the algorithm has already reacted before the commentator finishes the sentence. This creates a dynamic where the speed of information has become the ultimate competitive advantage, and humans simply cannot compete in that arena. And here we reach the point that becomes most unsettling when you actually stop and think it through. If the algorithms are all doing the same thing, reading the same data, learning from the same patterns, what happens when they all get it wrong at the same time? The flash crash of May 2010 is the most well-known example. Within minutes, the American market plunged nearly 10% with no real underlying economic reason. Algorithms reacting to algorithms in a feedback loop that no human being managed to stop in time. The market recovered that day, but the episode exposed a vulnerability that regulators and economists are still debating with serious concern today. When the intelligence controlling the system is the same intelligence that can destabilize it, the risks become systemic in an entirely new way. And for the average American, for anyone with a 401k, a retirement fund, or a brokerage account, this is not an abstract question. Volatility created by algorithms affects real savings, real retirement plans, and the real financial lives of tens of millions of people. But there is another side of this story that deserves to be told with the same honesty. There are researchers and economists who argue that the presence of algorithms has made markets more efficient, more liquid, and with tighter spreads, meaning the gap between the buying and selling prices narrowed, which in practice benefits anyone who participates in the market. Beyond that, the partial democratization of these tools is already underway. Platforms like Betterment and Wealth use robo-advisors to manage portfolios automatically at a fraction of the cost of traditional funds. What was once exclusive to Wall Street billionaires is slowly making its way into the hands of the American middle class. But the concentration of power is still brutal, and the technological gap between the biggest players and the individual investor remains enormous. The question that hangs in the air is not whether artificial intelligence will keep dominating Wall Street, because that answer is already obvious. The real question is, what happens to the market, to the economy, and to ordinary people when the most important decisions are made by systems that no regulator fully understands? And while that answer is still being written, the algorithms keep running, keep learning, keep evolving, and keep moving billions every single second. You, having made it this far, already understand something that most people have never stopped to consider. And that is exactly why this channel exists. To bring clarity where there is complexity and light where there is noise. If you want to keep understanding how money truly works in this world, drop a comment below with your thoughts on this topic. Your opinion matters, and it helps this conversation grow. Subscribe to the channel so you do not miss the next videos, and leave a like, because it helps this content reach more people who need to hear it.